Hi, what I'd like to do now is to spend some time working through some of the accounting standards which are concerned with how we report assets in general purpose financial reports. In doing so, I'm going to be presenting a framework which will help us to consider the regulation addressing assets. And when I talk about assets, I'm talking about things such as inventory and property, plant and equipment, which are relatively straightforward in terms of the regulation and the accounting requirements, and then getting into more problematic assets such as extractive industries and agriculture. The key issue which is going to be done here is that we're going to be identifying what assets are, and we're going to be identifying why asset information is relevant to users of financial statements. We can then progress on to the conceptual framework to see how this characterizes assets, and we're going to see that this has a number of implications for accounting standards. And these implications are going to be seen across accounting standards, so we're going to identify the common themes that exist across accounting standards, and we're going to use that to make it easier for us to read, understand, and apply accounting standards. That's very much going to dictate the way in which we work through the accounting standards and what we're looking for in the accounting standards. We need to recognize first off that the information that's presented as assets in the balance sheet is relevant for users of financial statements. There's significant evidence of this, and researchers such as Olson, Feltham and others, you'll see that they, generally speaking, build valuation models which incorporate the book value of equity, assets minus liabilities, into the valuation process, and that would suggest that they're relevant. There's also more empirical research, such as that by Collins, Maydew and Weiss, which considers the relevance of assets, liabilities and income to users of financial statements. And there's also evidence by researchers such as Easton, Eddy and Harris and Barth and Clinch, which identify that if we have updated asset values, then this makes the information in financial reports more relevant. So we know that what we report as assets is important for people. In terms of how accountants generally conceive assets, we can look at the conceptual framework, and we've talked about this previously, but if you look at paragraph 4.3, you'll see that an asset is a present economic resource controlled by the entity as a result of past transactions or events. We can also see that the conceptual framework provides us some guidance on how we're going to recognize assets in financial statements. We're told that we have to quantify them in monetary terms, and recognition on monetary terms might be done on the basis of historic cost or current value, and current value might be either of fair value, value in use, or current cost. And the current value that you determine to use is very much going to be a function of the context that you're in. Now, what we need to recognize is that how we recognize these assets is going to be very deterministic of what the regulation addressing those assets looks like. So this framework and how we recognize assets has some pretty significant implications for accounting standards, how they're structured, and what you should be looking for in them. So for example, if you have an accounting standard which is going to prescribe an historic cost approach, it is generally speaking going to have three broad aspects to it. First of all, it's going to identify what costs can be carried forward. It's then going to establish limits on the costs that can be carried forward, and it's then going to provide bases for recognizing those costs in the statement of profit or loss. So if you look at any standard which adopts an historic cost approach, it's going to be contributing to these aspects of how we account for assets. The alternative, if there's a current value approach, and that current value approach adopted is a fair value approach, what we're going to see is that these standards are quite different in terms of how they are written and how they appear. The fair value standards are going to be relatively straightforward, and it's going to be a two-step process. Step A, determine fair value. Step B, recognize the change in fair value in the statement of profit or loss. So what we can see is that how the conceptual framework characterizes the asset or allows the asset to be characterized is going to be very deterministic of what the accounting standard looks like. And we're going to use that to make it easier for us to be able to read and understand new accounting standards, because that will help us to understand what we're looking for. It's a roadmap. So the roadmap, in terms of where we work through here, is that we're going to start off considering historic cost accounting standards, and we're going to start off considering the accounting standards which are concerned with accounting for inventories. We start off with inventories because it's relatively simple. It's addressed in just one accounting standard, IAS 102 or AASB 102. We'll then move on to inventory. Inventory is a little bit more problematic, a bit more complex, because at the end of the day, property, plant and equipment is not addressed in just one accounting standard, it's addressed in multiple accounting standards. IASs 16, 23 and 36. But across those separate accounting standards, what you're going to see is that it addresses those three fundamental requirements. It's more complex because it's not just in one standard, it's in two. We can then move across to another type of asset, intangibles, and see how these assets are accounted for. They're accounted for on an historic cost basis, and you're going to see that once again it works very much through addressing these issues. What costs to carry forward, limits on the cost that can be carried forward, and bringing those costs to account. And we finish off our historic cost standards by looking at IAS 6, which is concerned with exploration and evaluation costs in extractive industries. So what we're going to do is we're going to consider a package of historic cost standards. We're going to I'd look for the common themes that exist across these standards and use that to help us to identify the consistency. And that's going to make it easier for us at the end of the day to read, understand and apply these accounting standards. The other type of standards that we see are fair value standards. And fair value standards are, on the face of it, quite simple to read. And we're going to start off by thinking about agriculture. And this is addressed in IAS 41. And the critical thing with IAS 41 is it lays out a very clear foundation for what fair value accounting standards look like. Measure the asset at fair value, gains or losses into the income statement. We start off with agriculture because it's a relatively straightforward context, and then we move through investment properties, and that will help us to appreciate what all fair value accounting standards look like. So at the end of the day, what we just need to identify is what type of standard it's going to be when it comes to assets, historic cost or fair value, and then we should look how the characteristics of that type of standard appear in the standard that we're looking at the current time. Please note this is a very holistic way of getting you to think about accounting standards. Please don't think about them in isolation. Please think about them collectively. Think about how they give consistent themes, consistent answers, and that will lead us to help us to make it much easier to understand the standards.